Hello, chart watchers, and welcome to this Wednesday, February 27th, 2019, Market Watchers Live Show with your hosts, Tom Bollinger and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, let's take a look at what's going on in the market today. We are seeing a little bit of weakness, although we are off the earlier lows. The Dow Jones Industrial Average currently down 95 points, the S&P 500 down just under 7. The NASDAQ down 17 points, and the Russell 2000 relatively flat, down about a quarter point. 10-year Treasury yield, you can see, trying to get back up through its 20-day moving average after starting the day lower, down around 2.63%. It is up to 2.68%. A breakout above that 20-day moving average, in my opinion, would be bullish for equities, as it would be a signal or a possible signal that we're seeing some rotation out of Treasuries and into the equity market. Volatility index on the rise here a little bit. The VIX up for about the third straight day. Not exactly soaring, but we are back up over 15. Just a couple of days ago, we were down in the 13s. Energy, one of the leaders today. Crude oil prices spiking. We do see some strength in energy. Also financials. These are the two strongest sectors. The two weakest, real estate group. This is one mentioned in the top and bottom segment yesterday. Negative divergence there. Real estate's been very strong, but looks like slowing momentum. And we're starting to see the problems unfold here with the real estate group just in the short term. Communication services also down today, down about 0.75%. Two stocks getting a boost today after earnings. Best Buy company's huge move, the best performer in the S&P 500 today. And Palo Alto Networks also seeing a big gap up after reporting its latest quarterly results. So, Erin, we are seeing weakness, but I'll tell you what, the market is holding up pretty well. It's not that panicked, impulsive selling that we saw back in November and December. Instead, it's just been this little steady kind of, pullback, but not really a whole lot of selling.
Yeah, I think the word I usually use is toppy. The market's acting kind of toppy. So, I don't see huge internal strength here. I mean, I wouldn't be hopping in a major way. Anyhow, maybe put the toe in the water a little bit, but yeah, everything looks kind of toppy to me. I'm still expecting to see more downside, but everybody knows I'm a bear.
Yeah, well, I mean, there's still a lot to be said for some key overhead resistance that we saw on some of the reaction highs back in November, December. Still got to try to get through those. I don't think we are going back down anywhere near those lows that we saw before. That's just my opinion. But pulling back to test some rising moving averages would certainly make sense given the overbought conditions. I do want to introduce special guests that we have today, Tim Ord, the Ord Oracle. Tim, you've been on here with us before. Welcome back. And what do you think of this crazy market?
Well, we are up against resistance, which is around that 2,800 on the SPX, and we are seeing some stalling here, but I'm not really bearish. I mean, we may have a minor pullback, but I think the worst case scenario is basically the 200-day moving average, but which is around 27, 25 range on the SPX. But I'm not a bear, and actually I can't really be a bull here either, because that 2,800, which is the November, December highs, it seems to be holding the market, at least stalling the market at least here. So kind of wait and see what to do next. So.
Yeah, we've got that overhead resistance for sure. And I think just about everybody is kind of watching that level, because we did, I think, on 3 separate occasions get up just above 2,800 on the S&P 500 and stalled there back in October, November, and December. And so now we're back up after that huge decline, coming all the way back up. We'll see whether or not we can get through. I know you've got a presentation for everyone, and can't wait to get to that. But if you can stick around with us for maybe about 15 minutes or so, we'll bring you back and you can let everybody know what you have to say at this point.
All right. Yeah, sounds good. I'll be waiting for you.
All right. Sounds good, Tim. Erin, why don't we go ahead and get going, and then we can get to Tim quicker.
Yes, absolutely. So our upcoming schedule looks like a good week coming up, as it always is. Of course, I know that first of all, we have the March seasonality report coming in tomorrow. Tom, you're doing that seasonality report, and you're doing a workshop the following week. Milan Vashnu will be with us on Wednesday of next week. And then we'll see what's going on today. Well, Tim Ord, we just introduced him, so he'll be coming on for our first segment. After that, the 10 and 10, your requests. Archer Daniels is going to be our first symbol, ADM. and we will finish off with the scooter report. Okay, Tom, take it away. Technical news and headlines.
All right, well, let's go into the economic reports. You can see on your screen there, December factory orders came in. They were a little bit less than, well, quite a bit less than expected. They rose 0.1%. Market was looking for 0.6%. And then January pending home sales, very, very strong number. And remember, I think it was yesterday, the day before, we were getting all of those December housing reports that were so weak. And here is January pending home sales, and you can see the strength, obviously, in January. So maybe that fourth quarter, as I've been saying, I think technically home construction stocks look a lot better. And maybe all that fundamental bad news is behind us. Things certainly look to be picking up based on this pending home sales report in January. All right, let's take a look at the bond market and see what kind of reaction we are getting. I did mention at the top of the show, we started down in the 10-year Treasury yield, but we have recovered. And we have been, over the last 4 weeks or so, this 2.63% area has been holding like a charm for the 10-year Treasury yield. But every single time we bounce up to the 20-day moving average, we fail. So is today going to be another failure, or are we finally going to get that breakout and begin to trade higher? I don't know. It's going to be an interesting call. I think if we take a look at a longer term, and I'm going to pull up a long-term chart on the 10-year Treasury yield because I think this is very interesting. I want to go back a long ways. It's a monthly chart, but I'm going to go back really to the start of the uptrend, which was back in the early 1980s. And if I annotate this for you, I think you'll see that we are literally right up against, and you could, depending on how you draw your line, maybe we've already broken out, but if I just connect that high back in 2007 and then the recent high, I mean, literally you could make a case that this is a major resistance level, but we've been uptrending for the last 2 years, 2.5 years. So if we can hold that rising 20-month moving average, and then also you can see the prior highs came in about that 2.60%. I think this is a key area for the bond market. Do we bounce off 2.60 and go up and definitively break this downtrend line, or do we simply go back down and fall into this longer term downtrend in rates? Very interesting time for the bond market for sure. All right, as far as earnings go, we still have a ton of earnings coming out. And when you take a look at this list, look at the bottom, look at the after the bell. We've got Booking Holdings coming out. I want to talk about that for a minute because Booking has a tremendous bullish seasonality that it is in the midst of right now with an earnings report coming out tonight. That one is going to be an interesting stock to watch. But you've got Hewlett-Packard, Monster, Square, Apache in the energy space. You got a lot of different reports coming out still, even though we are deep into earnings season. Pretty interesting. Most of the numbers, as you look at the screen here, most of these numbers were beats, or in the case of Lowe's and TGX, they just simply matched estimates. But really the only one that fell short was EOG Resources. So when we take a look at that chart, and I pulled it up on a relative basis in addition to the absolute chart, so you can see off the December lows, EOG bounced just like everything else, but it set a high back in the middle of January, and the markets continued going higher. So what you have is a stock that relative to its peers has been under a lot of pressure, and relative to the S&P has been under pressure since topping almost a year ago, 10 months ago. And then when you take a look at the group relative to the S&P, it's been very weak. So this is, I try to outperform the market with areas of the market that are outperforming. And right now, this is not an area, this part of energy and EOG in particular is just not cutting it at this point. Need to try and get through that 101 level, get some volume coming in. Until that happens, I'd be really careful with EOG. I mentioned Booking Holdings, so I want to pull that chart up because they do report after the bell tonight. And you can see overall, this chart, it's kind of so-so. You know, topped many months ago, and you can see that it has a huge impact on the overall travel and tourism industry group, which has been moving lower. Booking is not showing any signs at this point. Whoops, let's pull that back. Booking is not showing any signs at this point of a blowout quarter pending. I mean, we haven't really seen, we did bottom, I don't know, about a month and a half ago relative to the group. So it has been uptrending a little bit. But when you look at the stock relative to the S&P, we haven't been able to break out above this little bit of a reaction high, relative reaction high. And you can see the group relative to the S&P can't get the move to break out. But Booking Holdings might be the catalyst. And I'm just going to point this out because anytime I get a chance, this is one of the most, I don't know what the right word is, but shocking might be a good word when you look at the seasonal charts. Over the last 20 years, this is how Booking has performed in the period January through May, and especially February, March, and April, averaging 8% or more return in those 3 months individually over the last 20 years. So this stock has averaged producing about a 25% return February through April over the last 20 years. And you can see that the odds of these months going higher, 85%, 74%, 74%, clearly better than any other time during the year. So with this seasonality, I would have to still bank on the odds that we're going to get a good report out of Booking, or at least a good reaction to the report. Nothing's a guarantee. So obviously, if you decide you want to hold a stock like this into earnings, that's a risk that you have to bear. But this is a stock that definitely does tend to perform much, much better this time of the year. So I wouldn't be surprised if we see a really nice report. A couple other stocks that came out with earnings. Let's try and go through a couple of these. PSA, which is Public Storage, beat top line, beat bottom line. Stock was up quite a bit earlier, but is now pulled back. And you can just take a look over the last 6 months. Stock's gone nowhere. And especially when you consider that the overall market, didn't pull back, didn't break to new lows back in December, but it also hasn't broken to new highs, and it's just kind of in the middle of the range. So not something that I'm overly excited about. PANW, mentioned this one at the top of the show, Palo Alto Networks, big breakout here. And if we do go into that relative chart, what you're going to see is this is a stock that is performing very well relative to the telecommunications equipment group, breaking out to a new high versus its peers. It had been very strong heading into this report relative to its peers, relative to the S&P. So we shouldn't be too surprised that they easily beat their top line estimates. Revenues came in at $711 million versus $682.3 estimate. And bottom line, $1.51 versus $1.22. They guided their Q3 revenues higher, and they announced a $1 billion buyback. So a lot of good news. Look at the volume coming in on the gap up. So far, a black candle, so we may come back down and fill this gap. But I like Palo Alto Networks going forward. We just have to try to see how it trades the rest of the day. But this could be one that we could see set up pretty nicely over the next couple of trading days. VEEV, this was probably one of the best reports last quarter that I saw. And this was the reaction to its earnings, I think back in August. That was 6 months ago. And then I think the last one would have been at the end of November, somewhere in this time frame. But Viva has posted really nice results recently, and they did it again last night. Beat on the top line, beat on the bottom line, guided Q1 revenues and earnings per share higher, and also guided fiscal year 20 revenues and earnings per share higher. Stock was trying to break out earlier, reversing after a false breakout. I think this is a stock actually that could pull back maybe as low as 110, which was the breakout level. If it does, I think it would be a great reward to risk entry point. One other stock I want to mention is Lowe's. We talked about Home Depot and some disappointment there just earlier this week. Lowe's company actually said that they see a strong outlook for the U.S. economy. They did miss on their revenues. They matched their bottom line, but I think it was their outlook that got traders interested at the open today, but it has pulled back. Still, I think this is a stock that is helping the home improvement group, which really struggled after Home Depot came out earlier this week. All right, Erin, upgrades, downgrades, what you got for today?
All right, let's look. You know, it's been interesting the last couple of days, as I keep saying, there's been like hardly any upgrades. Today there were 5, and I was, you should only be interested in about 2. The other 3 were so low volume. So we'll look at those 2, and then we'll move on to all of the downgrades. There was an interesting one today too that I'll talk about. All right, so first thing off, you know, we really are overbought was my first thought. But then I looked, we've been at minus 7.5. So that means the range could move up past that 5 mark. So I'm kind of not as worried about that as I was before. And we do have a bottom that has now appeared here above the signal line. And I always find that especially bullish. Of course, that's being it's accompanied by a really nice price move. So it's not a surprise to see that little bump to the upside. But a couple of things that I like, of course, is this little short-term breakout above 30. We've got a 20, 50-day EMA positive crossover. So that gives us a decision point buy signal for the intermediate term. Not really thrilled with the scooter, not really thrilled with the volume patterns here, but overall we've got a little bit of a breakout. Can maybe see a move up to 32. According to DA Davidson, we should see a move up to 37 because they moved their target from 35 to 37. All right, let's look at our next one here, and that would be Philip Morris. All right, which is what I used to own, and I wish I had it now. It's been a pretty good performer here as far as the consumer staples do go. And so Philip Morris, let's see, Credit Suisse upgraded it from a neutral to a buy. They moved their price target from $86 to $101. So looking at that, I can see why they might have done that, given the overhead resistance that would appear here just about at that 100 level. We're getting stuck right now at 87.50, and the PMO in this case for Philip Morris is overbought, I would say. But we're seeing the right things coming out of the OBV, and we're seeing the right things coming out of the scooter as it rises. And there's that 20, 50-day positive crossover. Looks like we'll get the 5,200. I think this one could be interesting to look for the breakout, but just be careful because it is rather overbought. Not surprised after this really nice rally from those December lows. All right, let's move on to our downgrades. C.H. Robinson was downgraded today by KeyBank from an overweight to a sector weight. A few things that I noticed on this chart. You've got the PMO is getting ready to have a sell signal. So I have to say I agree with the downgrade in the short term for sure. We do have a 5,200-day positive crossover though, which means we finally got a long-term buy signal for a decision point. Puts it in a more favorable setup, a more bullish setup, usually when you have that 50 above the 200. But we're seeing that failure right now. The next area of support being right around, I'd say, 88, that top we had back here in January. That's where I would look at least for it to fall. And then one of the other things I noticed is that, you had OBV volume pushing to the upside, but price never was able to do that, even with the volume. And so when we see a lot of volume, but not the accompanying price action, that should also be a warning to us. So I think that there were some red flags already beginning to show up here for C.H. Robinson. Home Depot was downgraded today from an outperform to a market perform. The target Telsey Advisory had was 205, and they've lowered it to 192. So it looks like they're, hopeful that this gap will be closed. But overall, I would say they are expecting this to move down. I would say the same. I've got a PMO sell signal. Don't like that. Of course, you've got OBV heading lower, Scooter heading lower, and that was all set up on a negative divergence, really, as well. So it's holding up at this 200-day EMA. It looks like today we might get that long-term trend model buy signal, but the minute price goes down below that 200-day EMA, we'll lose that long-term signal. So probably a good downgrade. Red Robin was downgraded by Maxim Group from a buy to a hold. They changed their target from $46 to $29. Looks like it is headed there, but I suspect it might be headed lower. The good news is we do have some support here at those December lows. But overall, you can just look at the price action here, and it's just been rather dull. For one thing, look at this trading range we were in for quite a while. And then overall, we've been in this declining trend. So we are getting ready to hit that support level. But, volume isn't looking good. You could see it rising on that decline. I'm not expecting to see it hold that level, although I guess Maxim Group is. All right. And our final one is Weight Watchers. Now, this one was downgraded today by 7 different agencies. And I thought that was really interesting, so I had to look it up, of course. And one of the things I found out is apparently their fourth quarter earnings report fell short in, as they said, nearly every expected metric for the company. They've been trying to change themselves from a diet brand to a wellness company, and apparently that's not going over too well. We now have a sell signal below the zero line, ugly scooter. Everything about this chart is ugly. And we had warning here because we had this positive divergence finally showing up, but it failed to come off of that, and it failed to perform. Despite seeing this nice rise on the PMO, we just weren't doing anything. So that was also a warning that things weren't going the right way for Weight Watchers. That's all I have for today's upgrades and downgrades. And like I said, a ton of downgrades, so I won't read them. I thought it was interesting that Spark Therapeutics, ONCE, was once again downgraded today. Mainly I guess they bought or are bidding for something, another company. And, so they went way up in their price. Like it was, they made like more than 1/3%. And so I guess everybody's downgrading it now because it is so overbought right now. So interesting news there. All right, Tim. All right, let's bring it in. I know you have some great, interesting things to say, so I'm going to just leave it right up to you and you can get started. I'll be taking your questions, guys, in the chat room, and if I'll try and get those answered from Tim as we go.
All right. Is it going?
All right.
Sure. Okay, there we are. All right. I got a couple thoughts on the S&Ps, and actually after these couple of graphs, and we'll move into the gold market. Have some charts on that, and they're mostly long term, but short term, we'll take a look at some charts on the first chart. This is about the SP or the SPX or SPYs, but it's a Vix chart. And Vix sometimes can really, on a bigger time frame, show what to. In general, Vix moves opposite of the SPN or SPX or SPYs. So if you get a divergence, like both are going down, then that's a divergence. Both going up, then that's a divergence. But I wanted to point out a couple of different divergences over the last 6 months or so that the Vix showed some actually pretty accurate signals back in the October time frame, right off that September top. The SPYs, let me get a felt pen here or something. I can't see that. Hang on one second. Let me change the color. But in this time frame here, the SPYs was making lower lows. If you notice, up here, the VIX, this is the VIX up here, this is SPY down here, it just basically matched its previous highs, and I just took basically the close to close. But that was a bullish divergence, even though the SPYs was making lower lows. The VIX actually just matched its previous high, and that's a bullish divergence. That's suspected that since divergence was positive here, we expect a short-term bounce on the SPYs, and that's exactly what happened. And remember, everybody remembers the December decline. Well, the VIX actually, I didn't trade off of it, but the VIX actually gave a warning sign, even though the SPYs here made a double bottom in early December compared to its November low, which is double bottom. The VIX made a higher low, showing that there was a divergence. In other words, volatility is going to increase. Well, volatility did increase. It actually went to the downside. So that was one edge that the VIX did pick out, these two examples. One was a bullish divergence here at the October low, and at the December low, it was a bearish divergence. The VIX made a higher high, so it helped predict that the market went down. Well, recently, the VIX actually broke below its November. Let me change. Let me change the color here. 1 second. change it to a blue. But anyhow, right here we got the this is a VIX. If you notice, the VIX broke below its December low, and that's actually, where's my, there it is, December low compared to this low. If you notice, we're basically S&Ps wise just matching those, is matching its previous high of December high. So this is, in our opinion, like a huge divergence. I'm not saying we can have a short-term pullback here. We are running into resistance at that 2800 area, or 280 at the SPYs. But the VIX is suggesting we are going to actually break through that high at some point, because the VIX actually broke below its December low, suggesting that the SPY will break above its December high. So I just want to point that divergence out. When it's kind of a longer term divergence, because that December high is basically what, 3 months ago. So it's a bigger divergence, but we're taking this sign, this VIX divergence, as a bullish sign on a longer term basis. So, and we got another chart here that kind of suggests a bullish resolution also, which is basically the tick chart. The top window is a 100-hour moving average of the tick. The middle chart here is the this chart right here is the SPX. This is the chart below the SPX. Let me get another felt pen. There we go. And this is a cumulative tick with the 70 moving average. So when it crosses above that 7 moving average, the bullish signal, below it, the bearish signal. But and the bottom window is just the 30 hourly moving average. So it moves a lot quicker. But I wanted to point out some previous signals by this. But back in February of 2018, the ticks fell, the 100-hour moving tick fell below 0. Well, that was a pretty good signal, as we did get that decline. And also the cumulative tick fell below its 70-day or 70-hour moving average, which is also a confirmation. The next major signal came in would be March. March, if you notice there, it crossed its moving average. There's crossed its moving average. Both gave sell signals, and the market pretty much tumbled in concert. Back in the September high, the tick started, the 100-hour tick started to go negative. Basically, in early September, it looks like about the first week of September, stayed negative, even though the SPX gained ground. So that was a major divergence. And also the cumulative tick was also moving down in early September, warning that the current rally was not going to continue. Well, in general, the tick stayed negative until just recently, until about January 1st of 2019, and finally got back above 0. So the market has rallied quite a bit off its lows. But anyhow, all through that decline from September to late December, the ticks was either a cumulative tick was moving down, and the 100-hour moving tick, in essence, stayed below 0. So that was a major find. We do a lot of work with ticks. A lot of times we try to find examples where ticks work consistently, and this is starting to look like it's going to work consistently. Right now, if you notice, the SPX is still making around 2,800 on the SPX. The previous high is around 2,950. So right now it has made lower highs. But if you notice, the cumulative tick is back at its previous highs of September of last year. So it's kind of a leading indicator. We did roll over here a little bit, warning that there could be a bearish crossover here, but the cumulative tick is testing its previous high, suggesting that the SPX may get back to its previous high. The 100-hour tick is still above zero. So even though the market's kind of hesitating here, the tick has not gave a bearish signal, at least not yet. The 30-hour tick has, but it gyrates quite fast above tick and below zero. If the signal, if the 100-hour tick actually did fall below zero, that would be a bearish sign for the SPX. And so far, that has not happened. So what we're thinking, what may develop here, is no really significant decline. We may pull back a little bit, but we had thought at one point we might pull back down to bottom of this trading range down here around, give or take 20, looks like about 2650. We thought market might move down there, but the way the ticks are holding up here, it does suggest some strength in the market. But you know, the ticks could get weak here in the coming days, and we'll change our tune. But as it sits right now, the market looks pretty steady. If we start seeing uptick readings with the market going flat, that would actually be a bullish sign. We actually start seeing downtick readings with the market being flat. That's a warning sign that a decline may come. But as it sets, we think, in our view, it's not a good idea to look for a short position here, because the 100-hour tick, and actually even though the cumulative tick is still trending up, it's showing a little bit of weakness here, but really hasn't turned down yet. So on a near-term basis, we're at 2800 on the SPX. That is resistance, but the ticks are not giving a bearish sign here so far. So we don't have, we definitely don't have a sell signal. So we think the market may just bounce around this trading range here. So that's what we wanted to point out with the VIX kind of giving a longer-term bullish sign, because it's showing a bullish divergence. It went lower than this December high, predicting that the SPY will break above its December high, and the tick's not showing weakness here. So we're kind of, if we do get a consolidation here, and the ticks don't get wild to the downside, we'll think we'll end up with a buy signal. But as of right now, we don't have a buy signal. So anyhow, that's our view on the VIX and ticks. I just want to point that out.
Hey, Tim.
Yep.
Can I go back to the VIX? Can I show you a chart on the VIX?
Sure.
And then you can take the screen back. But I just wanted to show you a chart on the VIX. I think you might find this interesting. I think it adds to some of what you were talking about there. All right, so I've pulled up my chart here. Now, this is the S&P 500. This is a weekly chart that goes back the last 30 years, so all the way back to 1989.
Okay.
And what I wanted to do was to point out down the bottom here is the VIX. Now, this is a weekly chart. So, and these are going to be weekly closes essentially. But what I've discussed a lot on Market Watchers Live and some of the research that I've done, what I have found is that when you get into these bear market environments, that bear markets need fear and so forth, kind of like a tornado needs rotation. And when you go back and you take a look at some of the prior bear markets, now this was a cyclical bear market back in 1990. It was during the secular bull that we had, but this is where we fell more than 20% back in 1990. You can see that the VIX
held high. Yeah.
VIX did 15, 16. And then 1998, that was the next cyclical bear within the secular bull. And at that point, we once again did not see the VIX go below 16. Throughout the secular bear that we had in 2000 to 2002 and also 2007 to 2009, we never saw, during rallies, we never saw the VIX drop back down below that 16 area. And so when I was looking at this one, first, this is the what I consider to be a cyclical bear. I believe we're in a secular bull. So I'm looking at this now, much like I looked at this drop back in 98 and this drop back in 90. I don't believe we're in what we were in 2000, 2002, 2007, 2009. I believe the market goes a lot higher from here over the next several years. So I'm looking for more of a shallow bear market, a cyclical bear. And I think this pullback now on the VIX down below the 16 level, it's unlike anything we had seen in these other, bear market periods. And I think that's further confirmation that we're moving back into bull market mode. Do you have any comments on that?
Yeah, actually, you're seeing the same thing I'm seeing. The VIX is actually making lower lows, and the SPYs are. I think VIX kind of. You're right. Your long term. Yeah, I see the same thing. I think basically the decline is done. I don't know if to me, I think we've probably seen a V bottom in the SPX, because I don't see any reason at the moment to suggest we're going to go down and even test that level. At least not yet. The ticks are not giving any signals here, and the VIX, is remaining low, like you said, below 16. Mm-hmm. So to me, that's a longer term bullish sign. I think over the next couple of months, after this short term consolidation, wherever it leads, I don't think it leads much to the downside. We're probably going to start chugging higher again.
Yeah, and it's hard. It's hard to see it on this long-term chart because these weekly prices are kind of scrunched together here. But both in 1990 and 98, in these cyclical bear markets, we did bounce and have pretty nice bounces, and then go back down and either test the initial low or even break down below. Here, you can't see it because it's a weekly close, but intraday we went back down and we actually tested that prior low. So my initial thoughts were, when we went down, we'd probably come back up, bounce 10 or 12, 13%, similar to what we did back then, and then go back down maybe and put a double bottom in. But I don't know. The way it looks to me, with the volatility dropping so far, this, a bear market or, weakness requires a lot of fear, and the market's not selling off. We're not getting those impulsive drops in the market. It just seems like we got a different market environment now than we've had, certainly than what we had back in 2007, 2009, and 2000 to 2002, because volatility never went below 16 back then.
Right.
We've been trading below that level now for a little bit.
Well, that argues well with the possible V bottom. If we're going to make a V bottom, we probably would have held above 16. And right now, at least on the VIX, holding above 16, and we're not doing that. We fell below 16. So it kind of argues that could have been just a V bottom. But, time will tell. But it does look bullish. So
yeah, of course, as soon as I think I have everything figured out in the market, that's when the market throws a curveball, and everything.
Yeah, there's going to be a curveball in there. But, so
of course,
right, well, I'll let you.
That's what I'm waiting for.
Curveball.
Yes.
Yeah, I'm kind of in the deal. I think the bottom's probably in. Things could change quickly over the next 30 days, and all these semi-bullish signs could give way. The VIX could start spiking up for some reason. But as it says right now, if I had to be in the position, I'd be along the SPX. But I don't think this is really a good time to do it right now. But it could be, if we do get a minor pullback over the next week or two, it could end up with a buy signal. But
hey, Tim, I do have a question for you from the chat room. What is the tick indicator?
Ticks actually measure any given time the number of stocks in the NYSE are either on an uptick. In other words, last trade was 20 and an eighth, moved to 28, or 20 to 20 and an eighth. That's an uptick because the market last trade was a gain. And it takes all, I guess, 3,500 stocks in NYSE, and it measures all those stocks that are either on an uptick or a downtick, and accumulates. So at any given time, when you have like you said, had 650 uptick readings, in others, out of those 3,500 stocks in NYSE, 3,500 or 650 of those stocks were in upticks, either combined on everything. So
Tim, if you don't mind, if you could take that screen back. I don't know if you were showing the tick on your charts.
Okay.
No one could see it.
Yeah, I didn't know I could do that. I thought I had to share. Okay.
There you go.
But, yeah, excellent. But anyhow, the ticks, actually the easiest, best definition is actually go and just Google NYSE tick. I'll give you the best definition. But it measures basically the upticks and downticks of NYSE stocks, and it does cumulative of them. So in an up market, normally you have more upticks readings because the market's trending up. In a down market, you have more downticks because the market's trending down. So the cue is when you have markets kind of going sideways and you see a bunch of downtick readings on the tick indicator, that's more of a suggesting that at some point the market's going to start working lower. So, but anyhow, that's my tick indicator stuff right now, which is actually showing not bearish, but it's almost neutral readings on the ticks, but it is giving longer term bullish signs, as the cumulative tick did get back to the September highs, where the SPX has not. So if the ticks are foretelling the future, the S&Ps at some point should get back to the September highs, and possibly from there we may keep going. So anyhow, I wanted to point that VIX and tick thing out, and it's a good indicator to use. Another thing we want to point out is actually gold. Gold has this bull and bear markets, and we think we're probably at an important stage right now. We kind of watch, this is a monthly chart of gold going back to 1988. And what we want to point out on this chart, when the RSI is above 50, gold's in an uptrend. When it's below 50, it's a downtrend. And the top window there is the RSI. And so the blue area or green area, when it's above 50, we highlighted that, and it shows what the market did. And when it's below 50, it's usually the market's declining. And it flipped, RSI flipped to a bullish reading back in 2001 and stayed above RSI 50 all the way into about 2013, flipped below zero. From 2013 to 2015, it stayed below zero. And it kind of went back and forth here over the last 3 years. And now we're back above, RSI is back above 50 again. This is on a monthly time frame. So gold, according to RSI rules, is an uptrend right now. And it flipped back up, I think it was in January, as far as the RSI is concerned. The bottom window is a Bollinger Band spread. In other words, when the Bollinger Bands push together, volatility in the market's really narrow. And normally narrow volatility predicts the market will increase its volatility. In other words, after a sideways consolidation, an impulse wave will start either up or down. And the Bollinger Band's width measured that volatility, spread of that volatility. So the lower the volatility predicts that the market's going to start an impulse wave, could be either up or down. But back in 1993, volatility got extremely low, below 13. We're around 13, and the RSI flipped above 50, giving a bullish signal. So the market jumped up a little bit back in 93. Also did the same thing, low volatility going into that low of 2001, 2002. RSI jumps above 50, giving a signal there. Well, volatility again, Bollinger Band width got extremely narrow again, below 13. We're at 13.85 right now, and RSI flipped above 50. So it has been low volatility for quite a long time here, for actually looks like a couple of years, part of 17, all of 18, and 19, and RSI flipped above 50. So this method is on a buy signal right now. Okay, this is the same chart. I just took the price off. And what I have here is just a moving average of a 5-period, 8-period, and a 3-period moving average of the monthly chart. And all I want to show is basically bullish and bearish crossovers. Let's give me another. So right there, call it January 1st, all those moving averages crossed up together. So the moving average method is also on a buy signal, approximately at the same time the RSI jumped above 50. It's just another method of a short-term buy signal. So the monthly gold right now is on a buy signal on RSI method, along with the Bollinger Band spread suggesting a large move is coming, and the moving average is on a buy signal. flip to another chart. Here's a shorter term chart. This is GLD, the ETF for gold. And what we wanted to point out here, there's potential head and shoulders bottom forming here. We're right smack at the neckline right now. RSI is above 50. You can kind of see it easier there. And Weisskopf, to get through a resistance level, Weisskopf, which is a 1930s technician, wrote the Weisskopf method, his book, suggests to get through a resistance line, the market needs a sign of strength, what he calls a sign of strength, which is SOS. And that's basically a large price move with high volume passing through a resistance area. So around 130 on the on GLD, we'll need a sign of strength. Well, the market's been up 4 months in a row already, so we're seeing some strength right now. But in our opinion, we're probably going to see a lot more strength on a short-term basis. We're talking probably within the next 3 months. That to get through the 130, we're going to need one sign of strength through this area. So it could happen sooner, it could happen next week, it could happen next month, but we think it'll probably happen before May. It will probably bust through the 130. And this head and shoulders bottom, if you do the measurements on it, has an upside projection around 160, which is basically in this range right up. This range right up here. So we would project on a minimum basis, just with the measurement of the head and shoulders bottom, a target of around 160 on the SPYs. Here's a silver gold ratio at the bottom. We'll actually look at it, a future chart here, but it's also signaling kind of a bullish reading. This is not it, but this is a cycle on gold. There's a 15-year cycle. Gave a bull market buy signal in late, looks like 1985. Gave a bullish signal right around the 2000 level. 2016, that picked out that major low. And top of the cycle is usually about 7-8 years later. So this 15-year cycle has a projection high somewhere around 2023, give or take. But in general, we think the market could move higher into that time frame. We also noticed we did a Fibonacci level here. The market stopped at the 50% retracement level. And normally the market only retraces 50% of its last previous rally. At least goes back to make a double high, and possibly it could move much higher. If it moved down to 61.8% retracement, which is around the 900 level, at most it would make a previous high. So we're looking, according to the retracement rule of 50%, they should get back at least back to the 1900 level by 2023, possibly more. We don't know yet. But there's also an 8-year cycle high, which came in basically 2016, pretty much close to the 2015 high. So there's an 8-year cycle and a 15-year cycle high that hit in 16. So we don't think the cycle theory suggests that in general, over the next 3 years, we still may move higher here. Okay. Oh, this is a silver gold ratio. Okay. Yeah, this is a silver gold ratio. Normally, when the silver gold ratio, which is this chart right here, is when it gets down around 0.013, usually major lows have formed. In bear markets, silver underperforms gold. In bull markets, silver outperforms gold. So in general, we expect silver to actually start outperforming gold. And one of the reasons why is silver relative to gold is extremely cheap. The last time it got this ratio got this low, it was a 2003 low, it was a 2008 low, and a 2016 low. And we've been down here, the silver gold ratio, for about the last 4 or 5 months now, and it hadn't really moved off that low. And this is going to be typically when the bull market starts, silver should start outperforming gold. When it gets up to around 0.02, you have to worry. the last time that happened was back in 2006, 2007, and 2008. Here it just went bonkers. I mean, that was phenomenal there. But anyhow, if it gets back to around 0.02, that could be a bearish sign for both silver and gold, but we're a long ways from that right now. The bottom window is a Bollinger Band width again. When it gets narrow, below 25, it suggests an impulse wave is about to start. Well, the Bollinger Bands has been staying below 25 for the last 4, 5, 6 months. So volatility has been extremely low for silver. The last time we got this low was basically at that bottom of 2016, and again back in 2003 it got this low. So we should start seeing volatility, price movement in silver to expand here. In our view, it's probably already started because the RSI and gold is above 50. RSI for silver, and this is a monthly chart, is just, well, it's actually there it is, 47.75. So it hasn't gone above. This is a monthly chart. It hasn't gone above 50 yet, but it's heading in the right direction, you might say. One more chart here. This is GDX, and it's RSI is on a daily time frame, and we're right smack into the big part of the trading range. We fell below it. If the market can't hold its previous lows, which it did fall below it here, it'll attempt to take out the previous high. So the minimum upside target on GDX on a short-term basis, we think is 25. It could head higher than that, but RSI is above 50 on the daily time frame. So at the moment, we have to say GDX is still on an uptrend here. So I know I'm running overtime here, so I can hand it back to you, Tom or Erin.
Okay, well, I do have, well, first, I know there were questions in the room. I think some folks would like to get your chart settings, how you come up with these charts. I don't know if you can pull up and show the bottom of your charts.
Oh, no, I can't.
Oh, you don't have
where I checked, the settings. No, I took pictures of this and put it on. No, it's in. I can't.
Maybe you could go ahead and just send me a copy of one of your charts to share it later.
Okay.
And do it.
All right. Yeah. Ask me what chart, and I'll go over in stock charts and send that whole chart over.
Perfect. And then I can post it this afternoon.
Okay.
All right. I do have a follow-up question for you on gold.
Okay.
Just personally, we talked about this a little bit before the show started. And I agree with you. I think gold is in a nice uptrend. So at the top here, I've got gold relative to the S&P. Then this next part of the chart is just the absolute price of gold. And then down here at the bottom is the dollar. And then finally, all the way at the bottom is the correlation between the dollar and the relationship between gold and the S&P 500. And so first thing I would point out is most of the time is spent down here in this inverse correlation area, meaning that when the dollar is moving up, then gold relative to the S&P typically moves lower, and vice versa. So when we're in a weak dollar environment, then gold typically outperforms the S&P 500. And here we can see right now, at least in my opinion, we remain in an uptrend in the dollar. So gold, on a relative basis to the S&P, as long as we remain in this uptrend on the dollar, I would suspect that gold's going to continue to underperform. And so from an absolute standpoint, gold, I agree, has been moving up. And I think you mentioned right at the beginning on gold that we were moving into a really key area. And I agree 100%. I think when you look back over the last 5 or 6 years, I think it's pretty clear that 1350 to 1400 has been an area where gold has not been able to get through. I would just simply point out that even though gold is moving up, it actually is underperforming the S&P 500 again and beginning to roll over. And with a dollar that's still in an uptrend, that bothers me. So I'm not a big fan of gold because on a relative basis, I don't like it. But I agree that in the short term, it's on this uptrend, and clearing this overhead resistance would be great. But I don't know. We might need a breakdown in the dollar to do that. We'll see. What do you think?
Yeah, that's the whole key, that 1350 range. If we see a bounce through that or a rally through that with the sign of strength, then I think more upside. But if we turn back down 1350 again, then we're due for is that the sideways trading ring that's been going on over here for the last 3 years. Mm-hmm. We're due for a breakout either up or down. I mean, market doesn't go sideways forever. Right. And it doesn't go up forever, it doesn't go down forever. But 2-3 years going sideways, we expect some sort of a dramatic move up or down. Either we break through 315 or 1350, and we get an uptrend in gold and the dollar goes down, or we actually hit 1350 and turn back down and we break out to the downside. Right. So I favor the upside, and I think the dollar will actually weaken. So, but it's too soon to say yet. I think the 1350 will tell the story, what happens there.
I agree. We're definitely on the same page with that. All right. Well, before we go to the poll, I don't want to go poll yet. Let's go ahead, and I wanted to type in for everyone where they can find your information. So let me just, if you go to stockcharts.com /articles and then /TAC, then you can get into the top advisors corner where you will find all of Tim's articles in here. So if you want to learn more, you really found this presentation interesting, which it certainly was, you may want to go in here and pull Tim's articles up. You can see a lot of information here being shared, and then also you can subscribe just like you can at any of the other blogs at Stock Charts. Type in your email address, hit subscribe, and then every time Tim updates this his blog, you'll have that article sent to your email address that you provide. So a great way to stay in touch with what Tim is thinking and with the market. But let's go ahead and pull that poll up now, and because the question, and it kind of fits right into a little bit what you were talking about, when we look at the metals for the balance of 2019, and we got 3 choices here: copper, gold, silver. Tim, what would you go with if you had to invest in one over the next 10 months?
Actually, it'd be silver. I'm thinking there's going to be a bull market in gold, and bull market silver outperforms gold, so I would pick silver. Copper. If copper gets strong here, that's bad for the housing industry. Mm-hmm. And the housing industries have been showing weakness over the last several months. So the way I see it, silver, in my opinion, will outperform both gold and copper.
Okay, Erin.
That's exactly that's the one I picked for pretty much the same reasons. So. Okay. Market timers unite.
Yeah, there we go.
All right, I'm going to be, I'm going with the majority. I like copper. I think that the economy strengthens, and I think copper is more highly correlated to the direction of the S&P 500 and the economy than the other two. And I do actually favor the dollar continuing to go higher, which I think will put pressure on gold and silver. So I'm going to go with copper in the majority, but who knows? Well, we won't know until December 31st.
All right.
True.
All right, Tim, it was a pleasure having you on here. Always is. And we'd love to have you back soon.
All right. I hope you invite me back. I'll come back anytime. And thanks for having me on.
All right. Thank you.
Excellent.
Thank you.
All right. Very, very good presentation. Lots to think about. And it sounded like, Tim's thinking the market overall wouldn't be a bad thing to have a little bit of a pullback, but he's, staying pretty bullish as we go forward. I'd have to personally agree with that. But, until the market tells us something different.
Right. Exactly. Yeah. So, all
right.
Well, 10 and 10. Let's get it going. I have got a quick RRG that I can show everybody. And here we are. The main thing I like to show everyone as well is what sectors we have. Really pretty much a mixed bag today, Tom. So I'll let you get started with ADM, Archer Daniels, Midland.
All right. I'm not a fan. I can tell you right now, not a fan of ADM, and I will show you why. Couple things here. Number one, with earnings early February, we gapped down very heavy volume. And when we rallied recently, we tried to get back through some key areas, and so far we're failing. Until we can get through to the upside, and I'm going to say 43.5. I'm not going to be very interested in ADM until we can at least get back through where we were after earnings. That was the high we reached. So let's get to 43.50, number one. The other problem I'm having is when you look at the stock relative to the food products group, not performing well, relative to the S&P, not performing well, and the group relative to the S&P, you can see breaking to new lows. So this is just an area that right now is out of favor. I think the stock is out of favor within the group. And technically, I think we got some challenging obstacles ahead. So I am going to say pass on ADM for now.
All righty. And it looks like our most popular in the chat room is going to be 5 below.
Yeah, I was actually looking at 5. I mean, there's a negative divergence, so I'm expecting a 50-day test, but it's been pulling back, and I think is starting to look a little better to me in terms of reward to risk. So here was the problem. When we connect these highs right here, I think it's pretty clear that the PPO has been on decline. So that tells me momentum slowing. Volume on the latest high wasn't particularly strong, and now we lost the 20-day moving average. So I think this 50-day is coming into play. And I would look at this initial pullback off the huge rise as key price support. I think the 50-day down to about 112.5 is a solid reward to risk entry into 5 below.
Okay. Next one, JD.com. JD.
All right. So if on 5 below, if it goes 5 more below, never mind. All right, JD, let's take a look. Yeah, definitely has started to outperform again, breaking out to new highs. I think I would watch now the rising 20-day. When I said breaking out to new highs, you can see the reaction high here. We went down to put in a double bottom. We came back up. We tested this area, pulled back, holding the rising 20-day. That's a completely different animal than the last time we broke out above the 20, failed, broke out above the 20, failed, all this sideways action. Well, now on this move, we have been holding that rising 20-day, and look at the volume picking up. I think this one looks a lot better, and I think a test of this rising 20-day over here combined with price support, I think 25, 25.5, that area is really strong support at this point. I like it there.
All right, let's see. The next one up is going to be PBW. That is the Invesco Clean Energy ETF.
Yeah, I think it looks good. Light volume, but I don't worry about volume on an ETF as much because the ETF is designed to track its basket of stocks regardless of the volume. So I'm okay with light volume ETFs if you like the group and the basket. Here, I mean, it is continuing to move higher. It's broken out above these prior highs from the last 6 months. And when you look at where it is now relative to where it was at the beginning of December, I think the outperformance versus the S&P is pretty clear. So I think as long as, if I was in this one, as long as it continues to hold on to key areas of support, which to me, the big one is going to be that 20-day moving average. I think as long as we continue to hold that, I would be fine owning PBW.
All right. Let's see, the next one up is going to be for our Canadian friends, CNQ.
.to?
Nope, it's just CNQ, Canadian Natural Resources.
Okay. Yeah, it's at gap resistance right now. Definitely things have been improving, so that's the good news. I would be continuing to watch. There's that gap I was referring to. So here was the gap down with the heavy volume. Notice the reaction high here. We could draw an arrow in here just as a reminder. We got up to that gap resistance level, couldn't get through. Here we got close, couldn't get through. Here we got close, couldn't get through, pulled back a little, and now we're trying to get through. So is this going to be another arrow with a failure, or are we actually going to get the breakout? I would like to get the breakout, but I also really want to see the volume pick up. This volume is not suggesting to me that we've got enough of a thrust to the upside to get this breakout, but we'll see end of the day today.
All righty, let's see. The next one up is going to be PLD, Prologis. It's our only real estate sector request.
Yeah, I actually don't like the stock. I mentioned this one, I think, in my list of topping areas, things that I would look for. The good news so far is it's holding its rising 20-day moving average. So we're getting that test today. But the problem I have with the stock and with the group in general is that we've got the PPO rolling over, And here you can see higher prices. So this is one I mentioned yesterday. I'm not a big fan now that you do have some price support that should hit at about 68 and a quarter. But if that doesn't hold, I mean, you got the 20-day, then you've got that price support, and then you've got the 50. And when I get a negative divergence, a lot of times I will see this 50-day come into play. So I've got kind of a mixed feeling here on PLD. Good volume over here on the move, but the volume was drifting lower as we were making these higher highs with the lower PPO. Watch the 20-day. I think that's your sign. If we close below the 20-day, I think the volume could escalate.
All righty, next one up, Sirius XM, SIRI.
Haven't looked at this one in quite a while. Probably a good reason, because it just hasn't been doing anything. I don't think until I see Siri close below 640, I would be interested. Or did I say below? Above. Until I see it close above 640, I would not be interested. We've got a number of key tests along here. I think you can go back and see multiple tests at about, upper 630s to around 640 without a close above. Once we get above, then we're going to have gap resistance to deal with there, the intraday high. I mean, it's just going to be one area after another. But I could not be interested in the stock on the long side until we either started to make breakouts or we went back down and tested this low at 550. Here in the middle, I would pass.
All right. Let's see. Looks like it might be pulling back a little. Procter & Gamble, PG.
Well, I like this one, so if it's pulling back, I'm probably going to like, well, it actually went up, put in that bearish engulfing candle and has a slight negative divergence. Now, this divergence isn't quite as extreme as the one we saw back in December. Higher price, lower PPO, and we went down quickly. Went actually even below the 50-day moving average, got down close to the price support, gap support area before turning back up. But now we've got another negative divergence, also volume drifting lower as we go higher. So I think short term, I'd be a little more cautious on Procter & Gamble. But I do think that you're going to see some really good support if it gets down to about 96. So break below the 20-day probably would send it to 96. You can see the 50-day coming up from underneath. So I think if you get closer to 96, I would be okay owning it with probably a closing stop below the 50-day and looking for at least a move back up to test the earlier high. I actually think we'll get a breakout down the road on Procter & Gamble.
All righty, number 9, Salesforce.com, and that is CRM.
All right, CRM. I'm going to go ahead and put this one on the relative chart because you can see that CRM is breaking out above these prior highs, just like the overall software group. So really what you've got is a pretty strong relative performance, especially over the last 3 months or so. And that has led it to outperform the S&P. And of course, we know software has broken out to a new high versus the S&P. So I think this stock has all the makings of a stock that I would want to own. The question is, where's a good entry price? Recent low down at 153. That was right back to where that prior high was. I think the recent lows at about 157 and then the low before that about 153, that to me would be an accumulation zone on Salesforce on any pullback. But I think this is a stock that goes higher.
All right, and we'll finish off with a healthcare sector stock, CVS.
All right, CVS. And on looking at it versus, well, it's got it in the pharma group here. You can see the lower highs, but look at where we are on CVS. I mean, this is way, way low, and it's threatening a breakdown. Now, value, somebody who looks at stocks from a value perspective, that's not me. I like to trade momentum, so I want stocks that are outperforming. But I know there are plenty of value investors. You could certainly point to the lows that we saw earlier in 2018. We're almost there. Just watch this volume. I mean, if we do break below those support levels, I would be careful because there's a lot of selling, which tells me institutions are, definitely involved in this selling. To the upside, now that we've broken below all these prior lows, I think we're kind of contained right now between about $58.50 and $62. Let's see which level breaks first. But this is not the kind of stock that I would be interested in. In a market that's going higher, trying to make, get back up to all-time highs, you can see CVS has been just a horrible performer. So I would avoid it.
All right, and that concludes the 10 and 10. Here are those symbols that we just went over. You'll find these in the Market Watchers Live chart list. Just go to the Market Watchers Live blog from the articles tab, and you'll find the link right there at the top. And you can go in there and like, I think it was CRM, you can go in and get the relative chart and copy it to your own chart list, because I know a lot of people like your relative chart settings, Tom. All right, let's go ahead and do our final market update, and then we'll get into our final segment. All right, not the best day in the market. And, you know, I don't have the NYSE up here, but currently the NYSE and the Russell 2000 are the only major indexes that are in positive territory. As you can see, we started the day off with a little bit of a rough patch there, quite a decline, and now we're starting to take back those losses on all of those major indexes. And you can see the S&P 400 is in positive territory now. I don't like the NASDAQ coming up and then sort of curling over right at yesterday's close. Not a bullish sign. Also, you'll see Canadian markets, similar drop in the morning, but making its way up to positive territory. Treasury yields are definitely higher, 2.681%. The VIX is falling. It started off with a bit of a spike over 16, but now we've pulled back to just under 15, reading 1496. UUP is managing to move a little bit higher here. It's up 2 cents, 25.62. And GLD gapped down and is continuing to slide lower. That declining trend does not look like it's going to break anytime soon. USO, big gap in the morning, and now it's forming a little bit of a very short-term flag here. And of course, that is a continuation pattern, a bullish pattern. So I would expect a breakout above that $12 level for USO, currently at 11.96. TLT, big gap down, hit its lows for the day, hopefully at 120.50, and it is starting to inch its way back, trying to get back some of those losses from the morning. And a real quick look at our sector summary. Technology in the lead today. You can see that our laggards here are utilities and communication services. Interesting to see tech and consumer staples in the top 2 spots, given one's aggressive and one is defensive. So that's all I got, Tom. Passing it back to you.
All right, I'm going to take a look just quickly at the hourly chart on the S&P 500. And you can see that we are clearly over the last couple of days downtrending. That reversal that we saw back on Monday, I think, is definitely weighing on a lot of traders at this point. So I would not be surprised to see this continue. Now, what you do look at, or what you do see if you look back over the last month, is when we're above that rising 20-day moving average, that tends to hold as pretty good support. Here we went a little bit below after we had a little negative divergence develop. Same thing back here. We went lower after we had this negative divergence develop. But what I'm seeing now is a hourly PPO, which is at the 0 line. So I'm kind of waiting to see what the market does here. Does it continue this downtrend, or does it break back out above and begin to start to strengthen again? In a bull market, a lot of times you get these pullbacks for a couple days, and then you go right back into the buy. So that'll be something to watch. To the downside, what I would watch, I think from a price perspective, and again, this is short-term price support. Wouldn't be horrible for the market if we went down below this level. But I'm looking at this. If this truly is short-term weakness, maybe we move back down to the area of our last breakout, which is about 27.60. This is something I would at least maybe keep in mind as we go throughout the rest of this week and maybe into early next week. And that's basically what I had. So why don't we move into our final segment, which is Scooter Report. And I'll let you start it off.
All right, excellent. So I decided today, because we do the Scooter Report differently, I think, every time we do it, Tom. But today I decided I wanted to set up a Scooter scan. And mainly just because the Scooter Report, I usually go through the top 10, and I just didn't find anything that interesting in the low and highs for the scooters. So what I wanted to do was basically go in and find a stock that has a PMO that is rising today and has a 20 above the 50-day EMA and a 50 above the 200. So it's in a nice uptrend. It's in a bullish configuration. And then I'm looking for scooters between 70 and 80. So I want a strong scooter, but not at the tip top of the range, just because so much is overbought right now. And so I thought this might be a good way to get some pretty good results. And I actually did get some results over here, and about 88 entries. So I'm going to move this into my transient chart list called Scan Dump. I only put things in there that I know are going to disappear quickly. All right, and so obviously a lot to look at, 88, and I don't have time to look at all of them. So what I prefer to do is use my candle glance so that I can see what's happening with the PMO on these particular stocks and the setups. You know, something look interesting. And, you know, right now, boy, just the one that popped out to me right here is Allison Transmission Holdings. And one of the reasons it did is we got that PMO buy signal, sort of a fake out here. And now we're starting to rise. You can see the PMO. I would like to see it get above that previous top. But what I'm seeing is this, you know, break to the upside, and now it's pulling back. And you can see that that has gotten the scooter just to tick a little bit lower there. But I see this short-term support at 50. It's holding that support at 50. And like I said, a scooter sort of in the mid to top range, I'd be looking for a move up to 53. So ALSN is one that looks interesting. And I'm just looking at these fresh right now, guys. So let's see. This might be interesting here. Credit Corp. Let's get a closer peek at it. Kind of a low volume one. The PMO is on a sell signal, but it looked like it might have been scooping up. But no, it really isn't yet. But at the same time, you know, 245 to 250, it's in a nice little uptrend here. You know, might be interesting. BAP, not a first choice, just interesting. All right, what else might look good? Just anything that pops out. I like to look for those PMOs that are rising, of course, maybe that have pulled back and are starting to rise, or more overbought, are oversold. Let's see. Okay, I'm not seeing that many of interest here, but I'm going to look at this one. Looks like it's pulling back after a really strong breakout. FCN and industrial. And yes, it really turned itself around. You can see the scooter actually has made a nice move very quickly to the upside. The breakout happened, and now we're pulling back. So I always find that to be a good thing. The only thing that bothers me really at this point would be the top that we had back here in October. It is an intraday high, but yesterday's intraday high got stuck pretty much right on that spot. And you can see that we had some tops back here in August and September. So kind of an interesting one based on that scooter and the breakout. And now it looks like might be a pullback. And let's see one other here. Get one other in here and then pass it over. Let's look at the Invesco Senior Loan ETF. Wow, if I were a senior, I'd have been just about ready to kick the bucket, I think, if I saw this decline on my ETF from about 2270 all the way down to 2140. Yikes. But we did get the buy signal. It is in a pretty nice uptrend. Of course, the uptrend I'm looking at here is it looks parabolic. So while this might be interesting, you know, the PMO isn't completely overbought, and we're seeing strength here in the volume. You know, maybe we get a pullback to that 2270 level, and then it might be in a good position to come back up. But just beware when you're in the, if you are ever in a parabolic stock, to set that trailing stop. I think that's the best way to protect yourself. All right, so BKLN was my final symbol. I'm going to pass it to you, Tom. What are you seeing as far as scooters?
All right, well, I thought I would take a little different approach as well, and kind of just show everyone a little bit about the scooter and just kind of give a little history on the scooter and maybe show you on a chart kind of what to look for in terms of whether or not a company is going to have a strong scooter or not. So let's start off with first taking a look at the formula. So I'm just going to show you one stock. But first, before I do, I want to show you the formula for determining a scooter rank. So you've got your long-term indicators. 60% of a scooter score is going to be based on longer term indicators. And so you're looking at the percent, the price is above or below its 200-day EMA. That's 30% of the score. 125-day rate of change, 30% of the score. And then you get into medium-term indicators. So you're looking at the percent above the 50-day EMA, which is 15%. 20-day rate of change, 15%. And then the short-term indicators, which really don't have much impact at all in these ranks. But you can see 5% going to the 3-day slope of the PPO, and then another 5% on the RSI. Now, what I'm going to, I don't think we need to come back to that. So what I'm going to do is go into your dashboard, and under the top 10 on the large cap scooters, you see Xilinx, 99.9. So I thought what I would do is I'd pull up Xilinx here and just show you on a chart those different settings. So where you see pink, those are the long-term settings that are going to be determining 30%. So in other words, on Xilinx, if we look at the current price and we compare it to its 200-day EMA, and over here you can see I've set up the 50 and the 200-day EMA, we are currently roughly about 42.5% above its Xilinx is about 42.5% above its 200-day EMA. And when you look at the 125-day rate of change, it has a 64.59% rate of change. So in other words, if we're looking at this stock and comparing it to where it was 125 days ago, it's gone up 64.5%. So in order to get to the top of the scooter rank, you know that you've got a stock that has really been performing well in terms of price action relative to where it was 125 days ago, and also relative to where its 200-day EMA is. So picture a stock that's been really struggling for a long time. So the price is way below the 200-day moving average. And then it goes through a 125-day period like this. It's going to get a good score in terms of its rate of change, but it may not get a very good score relative to its 200-day, because after a big move, it's probably come up above the 200, but it may not see this kind of a gap between the two. Now you move on to the medium-term indicators, and you can see here, this is roughly 16%. Price action is roughly about 16% above the 50-day EMA. So that accounts for 15% of the scooter score. And then down here on the rate of change, you can see 12.74% over the last 20 days, which is the other 15% of that medium-term score. And so what you really see when the scooter on Xilinx, and I put the scooter down here, and now it's up near this 100 level. So you can see it has been one of the top performers for quite a while. And you also can see the significance of owning a company that has a high scooter score. Look at Xilinx. It was up in the upper 90s back at the end of October. When the market got hit in December, yeah, it went down, but it didn't go down nearly as much as the rest of the market. And by the middle of January, it was back near its high. With its latest earnings report, it gaps up and continues pushing higher. But just owning a stock like this that is ranked near the top in the large cap space, and owning it for, what is this, 1, 2, 3, 4, 5 months, the stock has gone from, even at the high here, has gone from roughly $85 to almost $125. So an investment here 5 months ago, you'd be up 50% on the stock. And that's not, after it's made this huge move. This is just knowing that you've got one of the top performers in terms of scooter rank back at the end of October. Many of these stocks will remain high for quite some time until we start to see some sort of significant deterioration. Now, the other 5% is based on the slope of the daily PPO. I'm not sure. I've never done the calculation, but you can see it's slightly moving lower here over the past few days. And then also the RSI is 5%. Looking at the RSI, it's internal RSI. So that's how you do the calculation. And you can see what happens with the scooter. As you start to see these rates of change drop here and here, that's 30%. This is the long-term rate of change. That's 30%. It's dropping. Here it's dropping, so that's another 15%. So 45% of the scooter score is dropping here. And look at what's going on with the scooter. You can see that dropping as well. Now, once you get to a certain level, these short-term drops don't have as much of an impact. And you can see Xilinx maintains a very high scooter rank, even though we see the medium-term rate of change dropping throughout this period, but the long-term rate of change really doesn't. It's just been a steady move to the upside. So when you see this drop, well, notice we also had drops back here. So when you start comparing longer-term performance, it really doesn't get impacted. And so you can see the drop here. We pull back, rate of change pulls back when the stock comes down here, but you can see the scooter score still has not budged. Anyhow, I just thought it would be cool to kind of take a different look at it, bring up all the factors on the scooter rank, put them on one chart. You can go down. I'll show you my settings here, so that if you want to come back and set something up, so that you can kind of track your stocks and how the scooter is moving back and forth, I think this would be a great way to do it.
Excellent.
Yeah, and that is it for our scooter report for today. Hopefully that was meaningful for everyone. And you know, when you get into these formulas, sometimes I think it's better to pull up a chart and just show you. It's really not that complicated once you understand the way that the formula works.
Yeah, it was great to see a visual of it like that, Tom. I really liked that.
Yes. Okay. So what do we got going on? You mentioned, you know, we had been rallying, but we're trying to get back through the, you know, those the open. You know, we were a week early, but we are coming back.
Yeah. You know, at this point that we're still seeing the S&P down. I just wanted to show this candle glance of all of the sectors before we go. You know, when I talked about the market looking toppy, I think it's really clear when you look at all the PMOs on all of these sectors. They're all overbought just about, and look at how they're all curling over. The only ones that look kind of healthy at this point would be materials, because that is still moving higher and we aren't overbought on materials. I thought that was rather interesting. And utilities still look pretty good, but even utilities are trying to decelerate and top. But look at how pretty much all of these sectors are just, the momentum is just not looking good.
Mm-hmm.
So I don't know. I'm still looking for a top, and you know, you have to. My dad says, you know, you go, Carl Swenlin, you go with what the charts are telling you. You can't just have this set mentality. So you know, at this point, I am feeling bearish, but I'm not going to lie. I'm certainly having doubts that we test those December lows, but I'm bearish in the fact that I do think we'll still pull back here a little bit.
Yeah, that makes sense. It makes sense too from an overhead price resistance. I mean, I would expect us, if we don't pull back here with multiple reaction highs from October, November, and December, all around this 2,800 level, if the market's able to go right through this level as well without much selling, I think it's really hard to argue that we're going back down to December.
Oh, absolutely.
Yeah,
absolutely. No, it's been a pretty interesting day, I have to say, and I know it's still going to be a pretty interesting week because we do have a really nice upcoming schedule there.
Yep, we got some great stuff coming up. When you were talking earlier about my seasonality report workshop, I thought I'd file for vacation for the next week.
There you go.
Yeah.
But you can't. I'm not going to be here. I'll be moving.
All right. Anyway, I want to thank everybody for being with us. Definitely a shout out to Tim Ward for joining us today. Really appreciate him stopping by. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everyone. See you back here tomorrow. Happy trading.